Welcome to TradeTheMBI.com. This is John. This report is for the 6th of March. No surprise here. We were seeing this hit of the 50% within a decent buy configuration right here. We had the spike that moved above the plus 13.5, giving it legitimacy off of that dip right here. But once we get to the 50%, I was looking for a spider effect to take place because we had this dip below the red line, and really they were going to have to prove pretty strong impetus. And given everything that we know, really didn't make any sense. When the Fed has to cut rates, when you see entire nations closing schools, not just in Italy, but I mean around the world. I mean, you're looking at hundreds of millions of children being sent home. There's a disconnect between the rosy picture that things will get better and what you're seeing in reality of a hyper reaction from governments. Why would they do that? It just doesn't make any sense that you would become that draconian for no particular reason. It hasn't happened in the past, and it just randomly think that that's going to be a rosy picture. We've already talked about it at length, the supply disruptions that this is going to create from China and the dependence that we have there worldwide. So is this any shock that we're right back to it? No, we were looking for it. We started to see it on the 5K chart early on, and I'll show it, and then it expanded into the 50K. And this is what you would expect to see with that coming right to the 50%. I would even have expected a little bit of breakthrough past, and then you start to retrace back into it. We knew that we were already almost into the extreme conditions here when we had yellow popping up at the peak. So that this is following through right back to what we expect, not that shocking. Not trading it that way, well, that's a different story. So from a NASDAQ standpoint, it's already a little bit worse. They're already well below the 23%. You can see the differential between it. A little bit more from a S&P, I think, as far as into the mid-range of that. But there's a bigger gap here on the S&P than there is in the NASDAQ. It's much narrower range. And that dotted line that ceased moving right there when we had this excess wave, literally almost identical. Just kind of like match them just like that, and boom. So kind of a value that's already been predetermined. Nothing to get excited about there. This is an interesting one because the talk of devaluing the dollar dramatically has always been a hot topic. It's something the U.S. has wanted to do for significant time. It really would relieve a lot of pressure, and you're seeing that kind of move. Because what is the possible justification for this? None. The EU is in far worse condition and getting worse faster than anything in the U.S. Now, you're seeing an exponential increase in cases of the virus and stuff in America, but look, we're not even at 1,000 cases out of 380 million people. There's a long way to go. And if this is starting out like it is within the first couple of weeks, what's going to be a month, 2 months, 4 months down the road when it takes, you would need till June, even at exponential rates, to even be at a number that compares to the current flu that's already killed, 18,000 people for the year. So, strange. Oil, not going to recover anytime soon. Gold is going to continue to skyrocket. That is going to be really the play that's going to continue to ramp up. So I thought I would go over the beauty of this 5K. What a mess this is. I had to shrink this way down. All right, so for the big short there, you watched me follow this on the Skype chat where I was putting up the trades in that, where I, taken the large position up here at the top, started covering it down at the bottom. We had this spike coming back up, and this is where I'll increase it because this is really, and there's some decent buys within this. I'm not going to deny that you're going to get significant moves. However, you have to recognize the predominant understanding is that without this steel coming back below, these can fail rather quickly, and you have to be prepared to see that when you get those crossovers back below. It'll come back above the cyan, and you'll get a little bit of a wave action, but then it just returns. And particularly when the steel is this high up, you don't have the reset of short-term buyers really pushing it through like they do when you come from a real, bottom move like down here, and it really catapults it to, significant levels. So what happened was we ended up with a lot of intermediate pops that then hit DLC spreads, some of them modest, but we were also dealing with pretty beat up shakeout when you're looking at it from these depths. I've always talked about this. Yes, you get the spike. There's the potential for it here, but you're still well below the negative 13.5. Yes, the yellow is crossed above in a wave, and that's what's giving the signal. You also have a pivot of the red DSC, but as I've pointed out repeatedly, when you're still below the negative 13.5, it takes an awful lot. So the question is, if you're nimble enough, sure, you can take those trades. But you have to recognize this is not going to be the one that, carries off into the wilderness. Now, as we moved over and we started to see the improvement above the negative 13.5, you have gold rising, also problematic because gold rising below 50% really doesn't do very well. The only advantage you had in this case was the falling Morganacci lines, which price wants to move towards the top of it, and in this particular case, it kind of really just did that. It wasn't a horrible situation, but at the point going forward, which was where it got really interesting, which was midday, and that was pretty much the end of it for me, because once I was there, it's like, okay, we're back to the 3063 algo level. We had this spike coming up. We had the first short configurations pop up right here, and I started to attack it in this mid-range just above the ABM yellow and the 100%. As a good indication, because we had the steel finally crossed above it. It popped back down below. Right at the same time, we got a DLC spread, but we had broken down into lower shakeout peaks, and we were finally below the negative 13.5. What was the entry level on this trade? Because I had split it. I mean, this was originally, I think, over 60 contracts. So 78. So it was a series of ranges that I was taking right in between every time we got the little pop. And the ABM value was right there at 74. So anything going on in between that to me was interesting, because oftentimes you'll get a break of the ABM and then it comes back and fights right with it, and that can be tenuous at times from an anxious standpoint, particularly when you really want it to break down. I had the steel reset, so the potential was, okay, hey, this could turn around, but the cascade with the negative shakeout, I was fine with that. And then when these signals came in, fine, it qualifies from a crossover standpoint, but no, you don't have orange going all the way below, and all you got is a steel that crossed below and back above. That's not going to be a sustainable buy in any way, shape, or form. And from my standpoint, it was just a matter of leave it. Now, when we did base over here, we had the improvements that you start to look for. Not off this first one, but the second one, where you're definitely above the negative 13.5. Fine, you can take that play, but from my standpoint, 3063 was the stop, because I was looking at this from a broader standpoint that was going to be, just the overall short in general. Now, you can play it like that. You could certainly follow the Morganacci's. In some cases, I know there's an anxiousness to want to, recreate situations, and you're looking for an ABM reset, but the ABM is not going to reset when it understands that the overall position of the market is below it. So while you may get buys below an ABM yellow, the ABM yellow is recognizing that that is the threshold by which to be short below. And in this particular case, no ABM reset at all, but where you could follow it then is the declining Morganacci levels. And that's just a matter of picking your preference. That's just about stop values. So whether it's 38%, 50%, 61, I mean, somewhere in between there. Following the 23%, well, then you're getting into super active trading, which It's not a problem. It's just a reference point. Let me expand the chart. This is getting hard. I try to give you as much information on this as possible, but everyone's got a different time frame and different preferences. So within the indicators, I'm trying to give you the broadest range possible. But understanding this correlation of when you get this steel unable to rebound. Now, in this case, it finally did so right about here. But again, it's this failure of the orange to drive below and the continuation of a crossover is what's led to this most recent part of the decline right here. I mean, it was pretty evident that wasn't going anywhere when that cascaded and you couldn't get the crossover. And then you had a de facto cross with the steel already below cyan, was already still within the short. So then it's just a matter of picking which algo line that we've already marked and you just go with it. But that's the most effective approach with this, because you're going to have this kind of volatility. And you know, like from my position, yes, I've scaled out, but I just leaving it. There's nothing else really to do. So this becomes one of those where you can convert a simple day trade into a massive broad trade. And this is no different than the one that we first did back on the daily that I was posting back up over here. Probably should have just left that one from the original, but traded it a few times in between. But that's how powerful sticking with some of the broader signals can be. Sometimes you just don't have to bounce in and out of a setup. I know even on the 50K, let's put that one in, why not? It had the nice intermediate buys in between, but once this sell came, certainly without a reset here, this buy from our standpoint, not really something I would want to take, or at least it's not that you wouldn't want to take it, because you could, but you just have to recognize that as soon as that steel comes back down, or you get the cyan green rejection, it's over. You know, and so in this case, the best it would have been break even to the tiny fractional loss instead of just sticking with that, because it just wasn't going to produce it. Now, if the green had crossed over, you know, like in this particular case, you've got a chance at something, but as soon as it breaks out and flips with that spider, and then obviously in this case the steel, that was the strong signal to the short side right here that popped right through. And look at, we're still within that. And again, this represents almost that exact same, you know, value right here. 50% was at 30.52. We have our other algo at 30.63. Pick between the two, but you know, unless the market can move back above there, you know, that's your trade. And I've scaled out of a couple of them, and probably if we get towards this 29.07, which is dip below the red line right here, probably scale out of the next portion of it, because the likelihood of a rebound, and then I can attack it again from a higher value. And that's just the general plan of it. So I just thought I'd throw that out there, because it's an important way to manage positions, because while we have great indicators from, you know, following a trend, you can just also just stay with the colors. It works pretty well. So hope that helps. As always though, be on the Skype chat. Trade well.